the big things we look at are price. Price is our, price gives us all the information. Then you can look at price, and then you look at book value, price to book, price to earnings. The current price we take as reality. Because you have to remember, there are thousands and thousands and thousands of people trading everything that's tradable. So if there's 100,000 people trading Microsoft every day, we're pretty sure that Microsoft is trading at the right price. We're not trying to guess how it might change in the future. We're not trying to guess Apple's next product cycle. We're not trying to guess whether Tesla can raise the next round of funds or not. Because we don't know that. No one can know that. But we can tell what the market thinks the price is. And then we can look at the business and see what kind of earnings they're producing. Okay? That's how we know what to invest in. And then the dividends are also a sign of value. Okay, so there's a mirror image between 2018 and 2019. 2018, we had fantastic earnings growth. Look at this. And we talked about this last January. We had 25%, I think at the end of the year, it averaged out to 23% earnings growth. Why? Taxes. Okay. And we had a down year in markets, 2018. This year, just ended, 2019, we actually had a down year in earnings, but we had a tremendous up year in markets. Okay? Does anyone see why or see anything that's interesting about that? We ended the year down. I think in January we talked about how we're actually slightly below fair market value on the S&P and on global markets. And now, even though earnings are down, we had a lot of space to make up. So the prices could go up quite a bit and still be, now we're slightly above fair market value in the S&P. Right? So the reason I would say, if there's a reason, is it was a good buy. Right? It was cheap. So earnings matter. And then this is really interesting about 2019. So because of the tariff stuff, because of the refiguring of supply chains and all these kinds of things, if you had a company that had more than 50% of the revenue from the United States, that company was up a smidge, right? If you had a company that had a revenue from outside the United States, they got really hurt, right? So that's how we get this average. That's how we get these. It's 4% down. We're about 50% inside, 50% outside in the S&P. This is the Shiller. We're gonna spend just a quick moment on this. And we're gonna send it on this because it's unique in the equity world. What happens when one subset of equities does really, really well for a long period of time, you get this. This is the S&P 500, and we're at a 2x, almost 2 times the long-term average PE ratio, the Shiller PE ratio, which is a 10-year normalized PE ratio. So about 2 times average. So that's kind of high, right? That's kind of high. That is not true internationally. It's not true in the emerging markets. It's actually not true for the value portion of the S&P. It's also not true for the smaller companies in the S&P. It's true for about 6 or 8 companies. So Apple's growth in 2019 was 3% of the 28 or 29% of the S&P. That's 3% of the 28. So what's that? A tenth. Basically, a tenth of the growth of the S&P was Apple. And if you add, not Netflix, because Netflix got hammered, Google, if you add Amazon, if you add, just a few companies, you get basically the whole return of the S&P, right? So that's where this PE is getting out of control on the S&P, is because we have a few companies that are doing really, really, really well. So we have in our process, while this is true, we have a reduced exposure to those companies, right? We do that intentionally. We look for value. Okay. And this is why far more money has been lost by investors preparing. This is the only quote you see probably once every 2 years. Like, this is Peter Lynch. He's a legend. He says this, And this applies all the time. You're going to see this more and more and more and more. Because so many people are trying to predict. The key is not to predict. Be humble about this.